Good afternoon, everyone from Kuala Lumpur, and a warm welcome to all our participants from around the world who have joined us today. I am Rosani Osman from the World Bank Global Knowledge and Research Hub in Malaysia. Before we start with today's proceedings, just a few housekeeping matters. If you have any questions for the speakers, you can send them to us on Slido. There will be yes, as you can see on the screen now, you can see the event code that will allow you to send us questions directly, as well as if you click on the polls, eventually you will be able to have an evaluation form. The form is now open and it will close shortly after the end of today's broadcast. So please do spend a few minutes completing the form, as it will help us in the planning of future events by catering to your needs more specifically. Back to our event. Ladies and gentlemen, while the COVID-19 pandemic has caused a severe global healthcare emergency, tremendous travel disruptions and movement restrictions, we remain committed to bringing relevant ideas and discussions that continue to shape the area of sustainable finance. Today's inaugural Green Finance Leadership Program webinar marks the beginning of a new series of webinars that will culminate in a GFLP conference in Malaysia sometime later this year, subject, of course, to the global situation returning to normalcy. This webinar is co-hosted by Tsinghua University Green Finance Center, IFC Sustainable Banking Network, and the World Bank Global Knowledge and Research Hub in Malaysia. We are honored to have three notable speakers who will give their introductory remarks, followed by our first session on environmental information disclosure by financial institutions, and our second session on disclosure by green bond issuers. Without further ado, I would like to invite Dr. Ma Jun, Chairman of China Green Finance Committee and Director of Research Center for Green Finance Development at Tsinghua University in Beijing, to provide his opening remarks.
Thank you very much, Rosani. Can you hear me okay? Can you hear me?
Yes, we can hear you.
Yes, we do.
Great. Once again, thank you very much. On behalf of organizers, I'd like to welcome all of you. I think there are 700 participants to the webinar. Welcome all of you to the discussion on environmental information disclosure, which is organized by Tsinghua University, IFC's Sustainable Banking Network, and also the World Bank office in Malaysia. This is part of the Green Finance Leadership Program series. As some of you know, in fact, many of you are members of the GFLP program. We started off with this Green Finance Leadership Program 2 years ago, which was organized initially by Tsinghua University Green Finance Center and IFC's SBM. And in the last 2 years, we hosted 4 major events in China, in Morocco, in Astana, and they were able to cover 60 countries with 600 participants meeting face to face. But now, given the coronavirus situation, we're switching our strategy towards online virtual meetings. And this is one of the first online communication events. And I'm sure we'll be doing many of these. In terms of the topic today, it's on environmental information disclosure. Let me just say a few words on the importance of this topic. I always said in the last few years, there are 4 pillars to a green financial system, including products, incentives, standards, and disclosure. Disclosure plays a critical role in the following senses. Number one, with disclosure, the financial markets and the lenders will be able to judge which projects or which asset is green and which one is not green, so that the financial flows can be directed to the right place, which is the greener sectors. And the second importance of the disclosure effort is allowing the government to put in the right incentives. The government needs to know where the money is going. If institutions are directing more resources to the green sectors, they need to be given more incentives, such as in the case of China, we were given them rediscounting facilities, relending facilities from the central bank at a low cost. And also a lot of local governments were subsidizing the green projects with interest subsidies and also guarantees. And all of these require disclosure. Only if disclosure is in place, the government will be able to find the right projects to give support to. And today's discussion will cover actually two types of institutions that will disclose information to the market, including financial institutions and corporates. The importance of financial institutions, including banks and asset managers, disclosing environmental information is that not only themselves need to know whether they are green or not, they should also know whether the borrowers of the banks and whether the listed company they're investing in are green or not. And by doing so, or compiling the information of the borrowers and the invested companies through the FI disclosure, they can actually incentivize or put pressure on the companies to be greener and to be more transparent. That's why we are inviting experts in the financial institutional space to give their experience and discuss options on how to enhance banks and asset managers disclosure. And of course, many of the underlying disclosure will have to come from the corporates, and the listed companies and the bond issuers are the most important ones to lead in this space. So with that, let me thank all of you, including the participants and also the organizers, for making this effort to launch this webinar, and I'm looking forward to a successful discussion in the coming 2 hours. Thank you again.
Shall I go next? Hi, good afternoon, good evening, good morning to all of y'all. This is Vivek Pathak. I am the Regional Director for IFC, currently based in Hong Kong. And I would first and foremost like to really thank Dr. Mar. He's been truly inspirational and leading the way, I think, for a lot of us in Asia and now at a global level to sort of take sustainability to the next level. I'd also really like to share my thoughts on behalf of IFC and the SPN. And at the outset, I'd like to thank Dr. Ma again on behalf of the work he's doing with the CFD and for making this possible, and also the World Bank Knowledge and Research Hub in Malaysia. I think the interesting thing, as I say, never let a crisis go to waste. And the interesting thing in this crisis is we're all learning to manage by doing a lot more webinars. We're all learning to manage traveling less, or actually traveling almost not at all for somebody like me. I've been in Hong Kong for 4 weeks. And I can tell you, when I look out of my window every morning, I see islands that I'd never seen before. So clearly the carbon emissions and the whole trend towards sustainability is being helped. Having said that, I think it also goes to show that we can find new solutions using technology. We can find new ways of doing things and cutting the carbon footprint. And I do hope that some of this trend continues. I'm sure my friends in the airline industry will not be happy with this, but at the end of the day, I'm hoping we can find a balance between less travel, which I think is a big contributor to carbon emission. Now, I'm not going to get into the importance of this topic. I'm hoping all of you all who are attending, and I'm told there are almost 600 people, which I think is the biggest sort of webinar I've attended in my whole career or my life, actually. 600 people, so quite an achievement. So thank you again to you all for joining, and especially those of you who are joining from the Western Hemisphere, which is at least 12 or 13 hours time difference with us in Asia. I'll just throw out a few numbers there. I think, I think we are beyond the stage of making the case of the importance of this topic. I think we're beyond that. I think I'm at least hoping we are, and the sense I get is we definitely are. But when you are talking to investors, they clearly want to see a business model that works. They want to see that this is profitable, this is viable. And the number I'll throw out here is that according to an estimate by IFC, that if we take the Paris commitments of 21 emerging markets, which are all clients of IFC, the opportunity itself is close to $23 trillion. So that's a huge opportunity. And I don't think that this task can be achieved purely by the private sector. It has to be a joint effort between governments, private capital, public capital, CSOs, and think tanks, a lot of research. So it has to be an effort which is truly going to be, I would say, on warlike footing. And that's the only way that we are going to be able to actually reach the Paris commitments that countries have agreed to. I think the good news is that over the past 12 months, at least, we've seen a lot of companies taking sustainability very, very seriously. And I think a lot of it is driven clearly by the vision of their leaders. But also, we've seen a significant shift over the last 12 to 18 months with a lot more international capital starting to flow into this space. When somebody like Larry Fink, who manages trillions of dollars for BlackRock, comes and says that sustainability is an important lens, or when Jamie Dimon of JP Morgan says that I think is good news, because at the end of the day, if more capital starts to flow to this space, and I would hope ultimately less and less capital starts to flow into firms that are not maintaining basic standards of sustainability, that's when we're going to have, I think, a quantum shift with companies wanting to move more towards that. So the good news is capital is flowing into the space. I think what's going to be critical to continue the flow of capital is a set of standards and disclosures which are common, because the last thing I think we all want is that money starts to come into the space and then there is greenwashing happening and people get disillusioned and we go back to the old ways. So which is where I think the topic you are discussing today is absolutely critical. And as Dr. Ma said, now this is the second phase. Having standards, having disclosure which people can easily understand and which are comparable is going to be critical. That doesn't mean we have one standard. I think companies, countries, different associations can have different standards, but the importance of disclosing them and being able to compare them is going to be critical. I think, there is evidence to show that companies that have gone on the path of sustainability, listed large companies I'm talking about, they have outperformed the index by, I think, something close to 6%. So that's a huge incentive. And I am hoping that as we start disclosing more and more, it will attract more capital, both equity and debt, which ultimately will mean that if I am a company that is doing a lot of good sustainable work and green finance, I will be able to attract a pot of capital that my competitors are not attracting, which will mean my cost of funding ultimately will start going down. It's going to take time for that to happen. And on the equity side, I'll be attracting a pool of capital, which is not coming today to me, which means hopefully my stock price will outperform that of my peers. And that way, I think we're going to have more and more people moving towards that. I think there have been a lot of studies that confirm this. And I think Harvard Business School did studies since 2011. I think there have been 3 studies, which further strengthens the argument that I just made. And I think as we see an acceleration towards green bonds, we are seeing this asset class truly becoming an asset class which can stand on its own. And the disclosure is going to create a lot of confidence, which is what is critical. As new investors come in, we need to create confidence. Now, what is IFC's commitment? We will continue to work with all of you all, our partners, through the SBN. We regularly talk to central banks on this. Just by way of example, last year, which is year ended June 2019, 48% of all commitments for my region, East Asia and the Pacific, 48% were in climate-friendly investments, as against something to the tune of 14% in 2014, which I think makes me personally very passionate and makes me believe that we can do this. It requires a little extra effort, possibly, but our commitment will continue. We are working very closely with companies to move towards this space. We are working with banks. We are trying to come up with concepts like green equity. But again, in order for us to come up with those concepts, we need the support of all of you all. And very important, we need standards that people can have a look at and get confidence. So with that, again, a big thank you to all of you all for attending this. And I am hoping that we'll meet soon in person. But having said that, I think this is a good example of 600 people that flown across the world. The carbon emissions, I'm just curious if someone can calculate that and put it out there. What are the carbon emissions we've saved by doing it like this? So a big thank you to all of you all. And I look forward to continuing with this. Thank you.
Thank you, Vivek, for your valuable comments. Next, I would like to invite Dr. Firas Rad, Country Manager for Malaysia at the World Bank Global Knowledge and Research Hub in Kuala Lumpur, to share thoughts.
So thank you, Rosani, and good evening, good afternoon, and good morning to everyone participating in this webinar. My name is Firas Rad, as Rosani just mentioned, and I'm the country manager for Malaysia. I'd like to thank at the outset Dr. Ma, Tsinghua University Green Finance Center, Vivek, and our IFC colleagues in SBN for co-hosting this webinar series. And it's a pleasure to join you at the opening of this webinar and to offer a few opening remarks on behalf of our World Bank Group Global Knowledge and Research Hub here in Malaysia. We certainly live and work in challenging times, as all of you know, as our countries and our global economic system work on managing and mitigating the fallout of the COVID-19 pandemic. And it is our hope that collectively we'll be able to rise to our own expectations and surmount this exceptional global crisis. But while we do so, I think we should not lose sight of the global climate change agenda as well and its profound importance for the future of our planet. And it is for that reason, as has been mentioned, that we are here today taking a small but important step in that effort to address the challenges of climate change. Disclosure of environmental information by both financial institutions and green bond issuers are a key element to boost investor and market confidence. It reassures investors that their investment is in line with their own principles by providing a degree of certainty in the level of environmental compliance. Financial markets, as you all know, hate uncertainty and will price assets accordingly. Assets with a higher level of green certainty should, everything else being equal, be priced above similar assets with a high level of uncertainty in its green credentials. Now, the World Bank has been at the forefront of this effort around the world. We introduced the first green bond, adopted stringent environmental and social safeguards in our operations, and we were a key participant in the development of the first green sukuk. And here in Malaysia, we are partnering with Bank Negara Malaysia, the central bank, Securities Commission Malaysia, the Malaysia Joint Committee on Climate Change, and the Association of Islamic Banking and Financial Institutions Malaysia in the development of a national green taxonomy and the sectoral guidelines. And now a key driver in our efforts is the goal of greater adoption of sustainable finance within the broader financial markets. Continuous innovation in products, services, and the adoption of common standards are important elements of success for this goal to be achieved. So on behalf of my colleagues in the World Bank Global Hub in Malaysia and myself, I look forward to the discussions today as we share knowledge and experiences from market practitioners who are leading experts and thinkers in their respective fields. As part of our continued support in raising awareness on sustainable finance, the World Bank will continue to use this virtual platform for future events. It's certainly very cost effective. So with that, I will turn it back to you, Rosani.
Thank you very much, Firas, for your topical remarks. Now, before we proceed, a little bit housekeeping for our audience today. You can use any of the available channels to send us your questions, and please do fill in the evaluation forms by the end of today's webinar. For our first session on environmental information disclosure by financial institutions, I would like to introduce our moderator, Wei Yuan, Sustainable Banking Network's Asia Coordinator, IFC.
Thank you, Rosani. So welcome all to this first half of this seminar. This session, we focus on environmental information disclosure by financial institutions. I'm your moderator for this session. My name is Wei Yuan, and I'm with IFC's ESG team, acting as Asia Coordinator for the Sustainable Banking Network. This is a global knowledge network that IFC has supported for financial regulators and the financial industry associations from emerging markets. So joining me in today's session are two speakers and one discussant. All three people, I would say, have deep knowledge and experience on sustainable finance. They're both practitioners and also thinkers, you will find, and also writers of books and leading reports. They come from three distinctive types of financial institutions: a bank, asset manager, and a multilateral development bank. So bringing the full area of experiences and perspectives. So I'd like to start first introduce our first speaker, Mr. Asadullah Ahmad, CEO of HSBC Amana Malaysia. You can see his background and introduction on the slide, but I just want to highlight that Mr. Mohammed's active role in the global sukuk market development. He has originated and executed multiple first-to-market sukuk transactions in Asia and Middle East, including the world's first UN SDG sukuk. So let me just hand over to Oz, as he's called, for your presentation.
Thank you very much for the introduction, and also just a big thank you to the IFC, the World Bank and Tsinghua University for arranging this. And hello to everybody who's out there. I heard there's about 600 people, and a special shout out to the folks who are in South America. So bom dia and buenos dias to you. So when we're thinking about this topic that we're going to go through, and you're going to be hearing lots and lots of presentations, what I can assure absolutely everybody on the call today is that from all of the presentations that you're going to hear about, mine is going to be the least inspiring. So that means that if you can get through mine, you can definitely get through all of the others. So with that said, what I'm going to do is start to talk about at a broad level, because there'll be different levels of, I guess, experience within non-financial disclosures on the call. I'm going to try and go through the framing discussion of non-financial disclosures, and then also after that, the specific implementation things that people can look at in terms of adopting it. And when I talk about framing, it's very important that we put the role of non-financial disclosures in the broad landscape of sustainability. So we're all on the same page as I go through this, and so people can reflect where they are with this. I'm going to be using the Next Sustainability Wave by Bob Willard as a framework. And that has 5 stages of a sustainability journey. It starts with non-compliance. So that's folks who don't have to comply or should but don't, and I'll give you an example in a moment. It moves on to stage 2, which is compliance. That's for the folks who are saying, well, I'm just going to do what I need to do, basically. I've been told to do. Then we look at this area called beyond compliance, so people are saying, I want to do more than just comply, but I'm not really sure what. And what I'll tend to do is maybe look at what other people are doing and what seems to be popular. Then there's a part of integrated strategy where sustainability is very much part of a strategic pillar of what a company is doing. And then finally, there's purpose and passion. And what that is where a company has made sustainability the heart of everything that it does. Now, when we look at these broad stages, I want to map those to kind of practices or assumed practices. Now, for non-compliance, actually, we know from the automobile industry, what happens is we've had some cases where people have actually said, oh, we are complying to something, but actually they weren't. So that's actually a practice that occurs, but I didn't want to write that down. But as we move on to stage 2 and 3, we have things that are called common sustainability practices. What these are typically copied practices and immaterial ESG issues. So this is linked to the SASB materiality map, where people are kind of saying, oh, well, I'm doing this thing for sustainability, but actually it's not material for their sector, but they're doing it because it's popular. And then when we move to stages 4 and 5, when we think about practices, we have what are called strategic sustainability practices, unique in their nature and also material. Now, what do these things translate to? And there's a role for non-financial disclosures across all of these. But what do they link to first? The first thing when we look at impact, and some people were earlier speaking about the surveys and the research that was done about impact on financial performance, what we find, and this was linked to the report that was mentioned that was issued by Harvard and written by Professor Ioannis Ioannou and George Serafin, that when we look at common sustainability practice during that compliance or beyond compliance space, what you find is that there's no significant association with things like return on capital. However, what's really interesting is that it is positively associated with market value multiples. And also, if you fail to keep up with the adoption of effectively common practices, then performance suffers. Contrasted that with people who are on stage 4 and 5, what you find with folks with unique sustainability practices, there is significant and positive association with financial performance, such as return on capital and market valuation multiples. What's important about all of this when it comes to non-financial disclosures is, one, by having them, actually there's a valuation positive impact, even if you don't really know what you're doing with it. But also when you use it to drive and reflect purpose within an organization when it comes to sustainability, there is a very positive financial performance that can be associated, as well as valuation. So let's explain why that's the case, and we'll move on to the next slide, whoever's. Thank you. So why is it the case that even if you just comply and have some type of ESG report, that you're kind of finding that there's it's beneficial? Why is it beneficial? So if we look at stock returns from 1993 to 2010, if you invested $1 at the beginning of 1993 in a valuated portfolio of high sustainability companies, you would have found that that would have grown by 2010 to $22.6. And what you would find if you did exactly the same thing, but for low sustainability companies, you'd only have $15.4. Now, the reason for that is the change in nature of capital, seeking and searching ESG or sustainable investments. We don't have time to go into why all that's happening. It's a short presentation, but what's important is that it is happening and it will continue to happen. So if you look on the right-hand side of the screen, what you will find is all of the different things that are happening in terms of the nature of capital, with one particular one looking even further into the future, saying that millennials are twice as likely than older generations to want their pensions to be invested responsibly. And that's a very strong indication of the continuing changing of the nature of capital. The point is, again, in terms of framing, what's this got to do with non-financial disclosures? Even if you just have them, there is some type of benefit. So with that, I'll just go on to the next slide. If we're talking about, oh, well, you know, what's best in class? Well, this is best in class. So if we look at 250 of the largest companies by Fortune 500 around the world, and these would be listed, what we find is that 93% of them have corporate responsibility reporting. And this is a big growth since the end of the 1990s. But what's even more interesting is that from the 93%, 78% of them have integrated reporting, meaning with their financial reports, they also provide these kind of corporate responsibility reports. So what we can see is that the largest companies in the world by revenue are doing this as a standard. And again, there's many reasons, part of which is the changing nature of capital. So with that, we kind of set the frame for why financial reports are important. We've made the point that there's this changing nature of capital, but we've also said if you just have these non-financial disclosures, guess what? There's some type of financial benefit. So if we can go on to the next slide. Okay, so now we're going to go on to implementation. Before we go on to the slide which goes into it, what I'm going to try and do here is show you that reporting is one part of a larger ecosystem when it comes into sustainability. The framing I'm going to use is something called value-based intermediation, which is being run by 12 Islamic banks within Malaysia, supported by the central bank, which is looking to get Islamic banks to change the DNA of the organization. Instead of just looking at prosperity or profitability, to be looking at profitability and prosperity with two other P's. So the first P is prosperity, the second P is people, and the third P is planet, looking at the people and planet impact whilst you're making money for an organization. And it's a transformational journey that changes the DNA of an organization. So if we can go on to the next slide with that set up. This is a very busy slide. I'm just going to briefly take you through it. VBI has three components that it looks at parts of the business with. Number one component is what is the strategy and policies, i.e. the board and senior management lens. There's the processes and actions, which is the colleagues working in the bank, their lens. And the last one is KPIs and results. Now, the reason for that is that it's not what you expect, it's what you inspect that gets done. So making sure that there's this reporting and verification process. These lenses are applied to these 6 categories you see in the middle, like a little tree. And what they do, as long as you make sure that they are done with delivering effectively sustainable practices, you will get value that is shown on the left-hand side. These are all of the outcomes. This is a proven way that this happens, and there's literature on it. Now, one of those 6 components, roughly 6, is reporting and transparency. Reporting and transparency is a critical one for all of the others, and it's not just about non-financial disclosures. It's more than that, but non-financial disclosures is a big part of it. Why? The reason is the moment you give information to external stakeholders that's very visible and very easy to access, and particularly when it's public, particularly when it's unsolicited in nature, and then you need to take voluntary action to make it better, it starts to impact directly organizational behavior and encourages organizational change, even if you're still at the compliance stage, if we think about those 5 kind of stages. Now, it provides a very powerful feedback loop into every. So for example, let's just take an issue. If we say there is a diversity mismatch in an organization, just as an example, we're not talking about climate now. If you're going to go and tell people that, guess what? People are going to want you to respond to it. Your own employees, your customers, and other stakeholders. It is more likely you will do something. So that's the importance. If you think about the power of that and applying it to climate and other sustainability matters, it shows why it's an important part. But just remember, it's one part. But for those of you who work on this area, really important for you to note that you can be a powerful advocate through that work that you're doing. So to go on to the next slide.
It's just a reminder, just 2 minutes to go. We're a bit behind schedule. Yeah, sorry for that.
Is it two? Have I taken 15 minutes? Oh, really? I've taken 13 minutes already. Oh, okay. I may go on to 3 if you don't mind, because I think the bits that people want to hear are coming next. So when we look at emerging standards, there's a number of them here. And the point that I want to make is when people are going down this journey, it doesn't really matter. These all provide a method of data sets that you can use. Financial institutions, I recommend a task force of climate-related financial disclosures, but they're different and they do different things. But the point is they inform the data set that go into your financial disclosures, and that's important. I'm sure you've read all of this by now whilst I'm talking and have absorbed it, so we can go on to the next slide. The point is that there's a bunch of them. Whichever one you choose to implement, what's really important in making this happen is the following, which is the governance framework. This is something that has to be mandated from your board, and the senior executive team has to take ownership of it. How it's then implemented is typically through the finance department, and the CFO has to be made if you could just go up one. The CFO has to be made the accountable executive, and that's very important. But also senior management need to provide challenge to that group that's putting it together. Why? You need to make these disclosures a mirror to show your warts and all. So senior management need to challenge what's going in there. So it's not just a publicity. It's something that genuinely speaks to issues and sustainability issues. The finance department, led by the CFO, certainly needs to make sure that the businesses and the functions are providing golden source information that they can be accountable to be accurate. And that all requires strong governance to empower them to get the information on a timely basis and make sure it's accurate. Of course, some people who are new to this may choose advisors, and for those of you who are listed, you may require auditing, but you may introduce auditing anyway because you make it mandatory for yourself. But this is a broad framework. The governance of putting this together is incredibly important. It starts from the board. And if I just go on to the last slide, and if you just give me 1 minute on this last slide, if you go to the next slide. People wanted to talk about the task force for climate-related financial disclosures and how it all gets put together. This is a cheat sheet that I use with board of directors to introduce sustainability generally into their organization with directors within Malaysia, which I've managed to be able to sit with 60 directors so far. Now, what this cheat sheet is who's asking a question, what are they asking and to whom in order to create change within the organization. So I'm going to reflect this back into the little circles you see. Most of you will recognize this as the recommendations for the Task Force of Climate-Related Financial Disclosures. The main board has to be asking the CEO, what is the bank's business strategy on sustainability? That covers the strategy part of the circles. And it's very important because even if the CEO doesn't know, believe me, if the board's asking, he'll quickly find out. The board risk committee needs to be asking questions. What are our sustainability risks? How are we managing and defining them? And how are we managing the long-term and short-term impact? That's got to be asked to the CRO, and that covers the risk management side. Because if you've got policies and procedures that answer these questions properly for the board, those are the types of things you're going to disclose in the disclosures. The board audit committee, and I've ring-fenced that because even if you don't want to go down the full line of kind of full sustainability change, as long as the board audit committee is telling the CFO where our non-financial disclosures, you'll get something done, believe me, however good or bad it is. And also to augment that is internal sustainability dashboards and MI is very important. This speaks partly to the metric side of the TCFD disclosures, but so does the performance scorecards and incentives for the management, which the nomination and remuneration committee will look after and should be pointing at the chief HR officer. The final thing is the overall governance, which is the largest circle. How do you make sure that's happening properly? The best way to do that is make sure that you're capacity building your board of directors. The reason is that under governance for the recommendations, the board of directors oversight is a key part of that disclosure. So the chairman of the board has to get the shareholders to give money to capacity build the board of directors and ensure that assessment of the board of directors valuation includes sustainability. And the final one is making sure that the nomination and remuneration committee on appointing the CEO and key responsible individual ensure they have credentials on sustainability. If you manage to get those questions asked in that cheat sheet and actions following on from that, you'll find it very easy to start to disclose material things into your Task Force for Climate-Related Financial Disclosures for those who choose to use that type of disclosure. With that, I'm out.
Thank you so much, always, for this excellent presentation. Sorry for reminding you. I think we're kind of a struggle between having every speaker to speak, but then every speaker is really excellent. And thank you so much for your presentation. Next, I would like to introduce our next speaker for this session, Mr. Frederick Samama from Amundi. He's the head of responsible investment. And I just also want to mention a couple of highlights of Mr. Samama. You can see his introduction on the slide, but in addition, I want to mention he recently published a book, The Green Swan, Central Banking in the Age of Climate Change. This is co-written with the bank BIS, the Bank of International Settlements, the France Central Bank, and Columbia University. He also recently spoke before the U.S. Senate at the Democrats' Special Committee on the Climate Crisis. So we'll just pass on to Frederick.
Ni hao, good afternoon, everybody, and I'm very glad to be with you today, and I'd like to thank Dr. Ma and all the organizers. And Dr. Ma is definitely one of the key people on the planet that has a key impact on green finance. So he deserves a lot of credit for that. That said, the first slide will be the executive summary. Next one. We all know that ESG investment is booming around the planet. That's a very, very good news. The slightly less good news is the fact that it's still confusing in terms of data and objectives. So clarity is absolutely needed, and proper data will help, while recognizing that the data is one step, but then we need to understand the forces behind the risks associated with ESG. So this very dynamic world behind the data is extremely important. In the meantime, what are we doing with data? I will give two concrete examples with the low carbon indexes. It's a technology that we pioneered about 10 years ago. And the Harvard Business Review recently published a paper that says that it's now a 50 billion market. And green bonds, I will elaborate very quickly on the use of data that helped us launch the largest ever green bond fund. We are deploying now $2 billion with banks in the emerging markets. Amundi, my firm, is the leading European asset manager. We are managing now $1.7 trillion. We have integrated ESG since the creation of the firm. So it's not something that we have discovered yesterday, more than 10 years ago. So it means that we have been through a long journey on ESG, and our CEO has recently taken the commitment that all our open-ended funds will integrate ESG by 2021. And we have developed innovative partnerships, not only with clients, but with corporates in order to help them align their portfolios with a low carbon economy. So we strongly believe that we are smarter together than inventing the wheel by ourselves. So next slide, quickly, and next slide. The world, very quickly, the world is very important in terms of ESG. It's a $30 trillion. Next slide. And what is more interesting is the fact that it's expected to grow. In the next 2 years, we expect the market to grow from $30 trillion to towards $45 trillion. So it's a $15 trillion increase in 2 years. And Deutsche Bank even think that by 2030, it will represent 95% of the market, meaning $125 trillion. It's huge. It's a tsunami. Next slide. That said, there is a tsunami, but a lot of confusion. Here is a graph that GPIF has prepared about 18 months ago that showed the correlation on the ESG scores for the 450 top companies in Japan between FTSE and MSCI. There's absolutely no correlation. It's amazing. Japanese companies, two very well-known providers, they are reaching very different outcomes. Next slide. The reason behind is that before the data, next slide, sometimes we forget to talk about what are the objectives. We want data, but for what? And here we think that you can elaborate you can say that you need the data for 3 different layers, depending on why you do ESG. We can say that ESG, you can do it because you want to express some values, like gambling, to be Sharia compliant, and so on. The truth is that here, very often you lose money. If you were investing $1 in the US equity markets in 1900, this dollar in 2014, 115 years later, was delivering $38,700. $1, 38,000. But this very same dollar into tobacco companies that are not exactly sustainable companies delivered $6.3 million. 38,000, 6.3. So by excluding tobacco companies, you were losing money. And then you can want to express some signals. You don't want to shift your portfolio, but you want to engage, you want to report on SDGs and so on. And for that, you're not looking for additional returns. You're just neutral. You're using your money to send some signals. And third, you can say that with ESG, you can generate some alpha. But here the question is, why ESG potentially delivering some alpha? And we think that there are 3 main reasons. The first one is that with ESG data, you can scrutinize the companies on some hidden risks, like a lack of good governance, some scandals behind the radar, and so on. The concrete example is Volkswagen. Nobody knew they were lying, but there was a lack of good governance. So it's a kind of 360 analysis. And corporates are more and more scrutinized, so it's important. Second, corporates are living into environments, and the environment can shift. And so with ESG, you can anticipate ideally these norms shifts. A concrete example, you were not paying your taxes at Google 10 years ago, you were a star, now it's more complicated. And third, and more interestingly, corporates have grown massively over the past 30 years, and now society is asking them to be part of the big challenges that societies are facing, inequalities and climate change. And if they don't bring their own solutions to this problem, they could lose their license to operate. But you see that suddenly, by splitting the objectives, we see that we will not look at the same data for the different, depending on the objectives. Next slide, quickly. Next, okay. We know about climate change. We know that if we do nothing, and page, oh, sorry, 32, 30, yeah, okay, 33. So if we do nothing, we go we increase massively. We know the challenge. We must cost to almost zero by 2050. Next slide. If we don't, we know as well that about half of the planet will be unlivable, meaning that people will, on a daily basis, will have to struggle with their lives to survive high temperatures and humidity. Next slide. Now, what is important, and that's maybe the second most important slide for me in this presentation, is the fact that we need data, but we need to recognize as well the links between the data. Because if we talk about the risks on climate change, that would be my topic now, focus, we can say that you have three different categories. You have regulations that are booming, that had started with the COP21. You have more and more carbon taxes or carbon markets like in China and so on. And you have nature as well, with extreme weather events that are booming, or sea waters, sea levels rising and so on. And you have society with millennials, was spoken about, technological shifts, migration or health. All these forces can impact asset prices. So we need the data. And we must recognize as well that these different forces are interacting with each other. And you have a lot of non-linearities here. And that's why we wrote this book about green swans, saying that all these forces are extremely important, non-linear, interacting with each other. And it means that it's almost impossible to write a model on how it will impact asset prices. Two non-linearities interacting with each other. Next slide. 30. Okay, so here I will shift very quickly. Here you have an example of a major shift. Here is a carbon tax in Europe. You see that the price has been multiplied by 5 over the past 12 months. Next slide. Here you have regulations. In Europe, in France, for example, diesel cars were representing 60% of the market, and suddenly a mayor of Paris said by 2021, you won't have any diesel cars in Paris. And so suddenly the market has shifted almost overnight. And what is true in Paris is true around the planet. Next slide. And here you have the migrations. You have 143 million migrants due to climate change just in 3 regions, including 86 million. You can imagine that the impacts on the policies will be massive. For example, if 10% of the African people are moving north, it means that Europe will have to receive 8.6 million migrants. It will have massive impacts on the policies. Next slides. And here you have the climate change physical risks. We tend to forget them, but they have been multiplied by 4 over the past 40 years. You have more and more typhoons, droughts, and so on. And what is more problematic is the fact that you have an insurance gap. When something happens, insurance companies are covering only part of the cost. It's a 56% insurance gap in the US, and even 92% in Asia, and 97% in Africa. Next slide. And so now, once we've said that, we said, okay, there is a boom. We need to clarify the objectives. We need to recognize that we need data, but links between the data. What can we already do right now? And here I would like to share in the next 5 minutes the 2 concrete examples that Amundi has implemented over the years. The first one is that back in 2011, we were challenged by one of the most sophisticated investors in Europe, the Swedish pension fund AP4, to set up a very straightforward, low-cost, scalable, transparent solution to reduce climate change-related risks. And the technology I will describe as I said, is mentioned in the Harvard Business Review of May, June last year, is now being used for $50 billion dollars. So it's pretty impressive. So the idea is super simple. You all know that a lot of investors are using passive products, MSCI, FTSE, whatever. What we can do is that we can take an index and analyze the constituents of the index. We take the S&P 500 and we scrutinize the 500 elements. And what we can do is that we can extract the most exposed companies to climate change and replace them with their peers that are better positioned. And we can do it without changing the market exposure. Next slide. So it means that if nothing happens, as we have the market exposure, investors will get the usual standard returns. At the opposite, if or when climate change risk will be priced, then the polluting companies will be penalized, and if you have excluded some of them, you will outperform. Next slide. And concretely, we can reduce by 50% the carbon emissions intensity. We can reduce by 68% the carbon reserve intensity with a tracking error of 76 basis points. Next slide. And the good news is that although it was a prototype, it has actually worked pretty well. Over the past 10 years, it has outperformed the market by more than 30 basis points around the planet. And you know, for passive products, where usually you try to outperform by 1 or 2 basis points, 30 basis points is a massive amount. So now this technology that we pioneered, again, 10 years ago, is being used by CalSTRS, New York Common Retirement Fund, GPIF, or New Zealand Superannuation Fund. Next slide. Now, I would like to conclude my presentation. Yeah, 2 minutes, 1 minute?
Just a reminder of 2 minutes, yeah.
Okay, I finish in 2 minutes, don't worry. Here, I would like to share with you another use of data dedicated to how to finance green infrastructures in emerging markets. We all know that there are massive needs, and on the one hand, and that we have pools of assets in developed markets on the other hand. And the wrong allocation of capital is costly for both parties. Next slide. With IFC, we developed a prototype that is now being used by AIB around the planet. The idea is super simple. We have the asset owners, and they were facing 2 problems. The first one, they didn't want to invest into emerging markets, recognizing that it's sometimes too risky. The second problem is that they don't know about infrastructures. There's a lack of knowledge. And so with IFC, what we set up is the following program. You have the asset owners on the right. They're subscribing to a green bond fund being managed by Amundi. And this fund benefits from a risk-sharing mechanism. So it tackles the problem number 1, it's too risky to invest into emerging markets. But then the moment of genius of IFC was to say this fund will invest into green bonds, and by it being issued by financial institutions in emerging markets. By doing that, the banks will collect the money from the investors. The investors will have the risks associated with the balance sheets of the banks. But being just a green bond, the banks will channel the money towards the green infrastructure projects. So we are decoupling the risks from the channeling of the money. Next slide. So we ramp up the program over the next 7 years. Next slide. We can say that we have avoided 233 tons of CO2 per 1 million euros. That's why we need the data. Next slide. And we can disclose, the countries and the CO2 avoided per country. Next slide. And as we have some data as well, we can check that we are aligned with the SDGs. Next slide. And to conclude, this project is more than a project, because it's a new way of thinking about the roles of developing banks. Forever, developing banks have used their balance sheets to finance some infrastructure projects. Here, we have a case study where a developing bank is using its own money to partner with the private sector to set up a prototype that becomes available for all the investors, and all these investors will play the roles that these developing banks will have played otherwise. So it's a fantastic leverage effect. And for that, we need the data. And it's working so well that we have already won 6 awards on this deal. And Xavier Muscat, the former head of the French Treasury and the former chief of staff of President Sarkozy, presented this initiative in a G20 report, having been delivered to the Vice Prime Minister of Singapore. So to conclude my point, my presentation, I would like to say, yes, there's a tsunami around the planet in terms of sustainable investment. Still, so we won the battle 1. The battle 2 is about clarity, and being part of clarity, the data. And then we need to understand the links between the data, and we need to provide some concrete investment vehicles to the clients in order to help them shift their money towards a sustainable capitalism. Thank you.
Thank you very much, Frederick. I think that ending slides also connects nicely to the next presentation. You talk about the private sector role, private sector approach. We hear from Amundi and the HSBC on how they've handled environmental information disclosure. But not last but not least in this session, I would like to introduce then from my colleague at IFC, Dr. Shi, or Stone as we call him. Now you'll be hearing from a development bank's perspective, IFC's own experience. Stone is a senior environmental specialist focusing IFC's investment in financial institutions in Asia. He has over 2 decades of experience in this sector, and he's one of the earliest IFC specialists to look at ENS risk among financial institutions in emerging markets. I'd like to invite Stone, please.
Hello, Wei, can you hear me?
Yes, we can hear you.
Hello. Okay, great. Thank you so much, Wei. Well, first of all, thank you for inviting me to this virtual panel. I also want to congratulate my colleagues here, HSBC and Amundi, for their efforts and achievements in the ESG area, including environmental disclosure. But before I start my own talk about IFC, maybe I can make some quick comments about what I heard from Frederick and Oath. I think Frederick did a very interesting presentation. I like the kind of a data objective perspective. That's quite, it gives us people in a different kind of thinking about the, what the purpose, what are the objective behind it. It's really insightful. I like that framework, although I still need time to understand better. But Frederick emphasized more and more about the importance of data. But then where the data is coming from, it must be from disclosure by different entities. Might be FI, might be from the regulators, might be about the nature, right? So again, I think this is a really excellent presentation, shows how important the data is and the disclosure is that can help drive new business, right, to protect our planet, right? And then the O's presentation also, like that sort of framing stages. That's quite exciting. I think I read some literature in a similar kind of, hierarchy or progressive in asking. O's suggests that there's a correlation at the stage 4 or 5 level. You will see a correlation between the disclosure, right, of whoever disclosed and their financial performances. So this is kind of quite interesting. You can't say, by disclosure itself, that can, make a better financial return. From a statistical perspective, right, I would see this is really, we call it spurious correlations, right? Financial performance disclosure. But what key is we call the underlying elements, we call latent variable. That's really the management quality. That's the ability to manage all kinds of environmental risks and performances. That drives both, a good environmental disclosure and also good financial performances. This is really exciting. And we see from O's presentation, we see additional evidence about how good environmental management can lead to good financial performances. Okay, let me quickly stop here, and then I can do a quick presentation, well, not really presentation, about how we do the disclosure related or reporting or disclosure related to our work when we assess our FI investment activities. Yeah, this is a slide. Well, this is a quick snapshot of IFC sustainability policy framework, and this is publicly available. Disclosure itself is the disclosure policy, the overarching policy that defines the scope of information IFC made available to the public, either as routine way or upon request by stakeholders. Right? So IFC disclosure policy has a requirement for both FIs, both ourselves and FI clients. Can you move to the next slide? Wait, next slide. Yeah, okay. This is IFC access to information policy, also called disclosure policy, informal. Right? I won't go into this because this is already available. Next slide. Okay, this is IFC performance standards. I want to spend maybe 1 minute on this. IFC performance standards provides really a performance-based framework for IFC clients to assess, manage the ENS risk and the impacts of the activities that are supported by IFC financing. Any of these performance standards, we've got 8 here, right, also include some relevant disclosure, or more probably I would say information sharing or communications requirement with various stakeholders, including, for example, project affected people and communities and workers. And I'll emphasize PS1, the assessment and management of ENS risks and impacts is very important for FIs, as it requires clearly that IFC FI clients all need to have an environmental and social risk management system in place. I'll talk about that a bit more. Can you next slide? Next slide. Wait, can you move to the next? Yes. Now, this slide really shows, I want to have this picture here to show our approach to our FI investment activities. So the left side is really IFC direct investment, where IFC performance standards will directly required. The right side is really the IFC kind of investment to FIs, like either through loan, equity, or other financial services. Right, so FI got IFC money or support, then they on-lend or invest in like we call a sub-project. It could be in a large, high-risk project or like small or low-risk project. We have different requirements to these, we call it sub-projects. Could be just IFC exclusion list, national laws, or IFC performance standards. So, the thing is that we call the IFC finance portfolio is really the FI's portfolio that being supported by using IFC funds. Typically, IFC's ENS requirement, including maybe disclosure, is only related to the IFC supported portfolio. So I want to emphasize that point because people often got confused about, where IFC's requirement will be applied to the FI's own portfolio. IFC requires, actually the ESMS stands for Environmental Social Risk Management System. IFC requires all the FIs we invest to have a system in place to manage the risk. Next slide.
Hi, Stone, just a reminder of 2 minutes to go.
Oh, okay, quickly. So I first spent time on discuss the previous two presenters, right? So here is more like FI disclosure reporting. Here I use disclosure and reporting interchangeably because you could argue that the disclosure is just a special form of reporting or vice versa, right? Let me go through some, I say, good practice or requirement here. Bullet 1 is really, we will require the FIs we invest in need to comply with applicable national laws that relate to ENS disclosure. That's a no-brainer. They have to go do that, right? For example, some countries already have specific laws or regulations related to the FI's disclosure itself. For example, China has a green credit policy that has some disclosure requirement for FIs. The second bullet point is really say, we would expect or require the FI to require their borrower, sub-borrower or sub-project to disclose following the host country or host country's national laws related to disclosure. For example, almost all countries will have environmental impact assessment law. That law probably requires the company or project to disclose locally to the locally affected communities such that they have opportunity to participate or review the project, provide this feedback to the government for decision making. The third bullet points, we require IFC clients to establish a stakeholder engagement or communications mechanism. And this communication mechanism is like two-way. So when we talk about disclosure, typically we think of one way, but stakeholder engagement or communication mechanism has a two-way dialogue. So we require that, particularly for FIs that we consider high risk, meaning they're doing high risk activities. As a good practice, we always push or recommend our client, FI client, to have internal reporting to their own senior management, other internal audience, like credit portfolio management. This is part of the governance structure Oz mentioned earlier. And the next one will be disclose report to IFC as an investor on ENS form. That's obvious, right? We may require the FI to tell us what's their ENS policy, risk management approach. What does their portfolio look like? You know, for example, sectoral breakdowns, like high-risk activities, exposure to coal, exposure to IFC, we call it exclusion list, and even the material accident happened during the year, right? Such that we know the ENS performance of the FI. This might be unique to the DFIs like IFC because we have the broad mandate of development. And then many of our FI clients can voluntarily adopt some industry standards. And here you already heard green bond principles, maybe equator principles. Yeah, there are lots of these industry-related initiatives. Even the global reporting initiative is another example. But finally, I will stop here, is that we see the disclosure would be best incorporate a FI's environmental and social risk management system. And experience shows that such requirements or good practices, if it's not formalized or institutionalized, will never get truly implemented. And this should be, again, part of the FI's governance structure or management system. Right? And last word to say, if this disclosure or environmental social risk management system is a good quality, with that, you can attract international investors like IFC. Let me stop here. Maybe where you say you have questions to ask, right?
Yep. Thank you very much,
Sure.
Stone. Thank you. And that's a good input and also helpful in linking the earlier presentations from Oz and also Frederick. Now, we don't have too much time, unfortunately, for questions. Our team has actually picked one question that was submitted from Slido. I would like to pose the question to all three speakers, and can I ask each speaker to hopefully give a short answer in 3 sentences so we can move on to the next session. This question is really on standards and best practices. I think all of you touch upon this in your presentations. The question is, what environmental data disclosure standards, protocols, and ratings are the most advanced or considered best practice globally? And these should also generate, involve low greenwashing risks. So it's a question about standards, ratings, and best practices. Can I ask Oz to answer first, and then Frederick, and then Stone? But I would just kind of ask you to limit your answer to be a really short one. Thank you.
Sure. I'm just going to have to ask you what the question is again, actually. I wasn't quite clear.
Okay. The question is, what environmental data disclosure standards, what in kind of a global standards, protocols, and ratings are the most advanced or considered best practice globally? I think this is related to some of your discussion on TCFD, GRI, SASB.
Yeah, okay,
You have one slide. Yeah.
Yeah, okay. Just before I answer that question, just to mention on Stone's point, my presentation was noting that particular practices lead to superior returns or so on and so forth. That's the causal link. The correlation, there is some correlation links as well associated to that. So just to clarify that point, it was about the practices. Okay, now when it comes to what is the best standard, it depends who your audience is. Right. Okay. So if you're looking internally and trying to reflect internally, the SASB standards for your sector will help you to understand the impact of the company from an internal view. When you look at externally, for example, aligning with the UN SDGs, you may want to look at the GRI standards, and that's talking about what your impact is on the world. When you're looking at integrated reporting frameworks, that's about bringing the financial, non-financial together and a method to go there. So when we look at data sets, it's important to understand who is your primary audience. So unfortunately, it's not a specific answer to the question because there isn't one, but that's basically my more than 3-sentence answer.
Thank you. Frederick?
So I will try to make it short. I would say that SASB works well. And I would like to add another point is to the fact that this data should be freely accessible. Ultimately, what we want to obtain is to put pressure on corporates. For that, we need the mobilization of civil society. And so civil society must access freely to the data. So that's something we have not debated today, but I would like to mention is that too often we have data providers between the corporates and civil society, although it should be a public good. So SASB and data as a public good.
Thank you. Stone?
Yeah, sure. I agree both Oz and Frederick was saying, but I just want to add one point is that we need to see the data standards or practice as an evolving concept, right? There's no best, you got to start with somewhere. But once you set a standards concept in motion, right, it will improve over time. The quality will get better, it will become more relevant. So that's a thing. I think the key things I see is the good thing. We already started this trend, and that's very important. I believe the data quality standards will get better and better, will meet, all the stakeholders' expectations. But it will take some time. Thanks.
Great, thank you. And I guess I would just give a round of virtual applause to all our speakers, and thank you for your excellent presentations. Hopefully in future seminars, we'll be able to have opportunity to dive a bit deeper into each of those standards that was discussed in today's presentation, TCFD, GRS, SASB, and then more time for Q&A. With that, I will just pass back to Rozani. Thank you.
Thank you.
Next up, just a bit of housekeeping. Just a reminder, you can send in your questions on Slido. And now I'd like to introduce the next speaker. The next moderator, Cheng Lin.
Thank you, Rozani, and also thank you, Yuanwei, for moderating the first session. Everyone, welcome to the second part of the webinar, the environmental information disclosure by green bond issuers. I am very happy that we have actually 4 speakers, including 2 distinguished guest speakers. One is Ms. Tan Ai-Chin from OCBC Bank based in Malaysia, and the one Green Geng Crystal, Geng Yicheng from Ping An Group, and also 2 discussants. One is Shankini from CBI, and one is from Cisco from the FC. I have to say, technically, the 2 guest speakers are also from the financial institutions, which are very much like what we have in the first session. But in the session, actually, the 2 guest speakers are also green bond issuers themselves, or they are also helping corporates to issue green bonds. Without further ado, let me just introduce Ms. Tan Ai-Chin for her speech on the presentation. So Ai-Chin actually is sitting on the board of several companies within the OCBC group, and she has more than 30 years of experience in investment and the corporate banking activities. So without further ado, now let me invite Ms. Ai-Chin to give her presentation. So Ai-Chin, the floor is yours.
Yeah, thank you, Cheng Ling. Can you hear me? Thank you, Cheng Ling. Can you hear me?
Yes, I can hear you. Please go ahead.
Okay, great. Yeah, good day to everyone. I'm indeed have great pleasure to actually be part of this very distinguished panelists to talk about this very important, sustainability agenda for, the country as well as for the bank as well. So my presentation framework will talk about, firstly, OCBC's sustainable financing journey. Then we will go to talk about what are the standards that are applicable in Malaysia. And subsequently, I will just touch a bit in terms of, what is sustainability bond, and thereafter, Malaysia's renewable energy journey. And I will just give a little bit of case studies on solar financing and another one on social impact bond before I go to end the presentation to talk about sustainability disclosure requirement. So on the first page, if you can see about OCBC's journey, I think as all my fellow speakers have actually alluded to, obviously it is very important as a financial institution to lead the way in terms of all this sustainable financing development, to ensure that we are able to also convince our customers to do the same. So as investment banker, helping the customers to actually look at bond issuances, loan financing, we ourselves have to lead the way in terms of all this sustainability agenda. And OCBC is the first South Asia bank to actually prohibit new financing on coal-related power projects since 2019. And we have actually now have global outreach of sustainability financing footprint, in all the networked businesses that we have. And at the same time, we have actually put a commitment to ensure that we will actually have sustainable financing commitment up to 10 billion in 2022, and we will actually double that by 2025. Yeah. So next page, please. So if you look at the green and financing standards, in a way, a brief of Malaysian snapshot. Certainly what we have done in Malaysia is that, with the lead by Securities Commission, who has actually co-chaired the Sustainable Finance Working Group, they have actually followed or mirrored what we have done actually under the Global Bank Standard as well. Global Bond Standards, by ICMA. And so in the ASEAN standard, we have got all the standards that have been put in place, the green bond, social bond, as well as the sustainability bond. But on top of that, what Malaysia has done is actually to put up a sustainable and responsible sukuk standard. As you may appreciate, I think Islamic financing is a core, financing instruments that is applicable in Malaysia in many parts of the world now. And so we have actually set up this standard, which is actually unique in Malaysia. And this standard actually is applicable to sukuk. And the government actually give tax incentive as well for issuers in terms of tax relief for issuances expenses, as well as grants to cover up to 90% of external reviewer expenses. So this, in a way, help to also promote the agenda about sustainability bond. Maybe next page, please. So if you talk about sustainability bond, what is it exactly it entails? It is actually combining the features of green bonds and social bonds into one product itself. And I think OCBC is actually very glad to mention that we have actually pioneered the first transaction in this sustainability bond framework. And it is actually through a solar power project. Next page, please. So maybe a little bit about why solar. Actually, Malaysia has started also our renewable energy journey. We have actually put a target of 20% target in 2025. And unfortunately, at this stage, we are still quite low at 2%. Most ASEAN countries have also targeted between 20 to 30% mixed, within this period of time. So what Malaysia has done is that we have actually speed up, providing opportunities for market players to actually bid for all these what we call large-scale power projects in Malaysia. And the recent power bid that we have actually put up, we received actually 700 bids, and of which most of it are actually, of course, local players, plus many international players as well. And we have actually selected 5 bidders from there. So, you may ask, why actually solar in Malaysia? Obviously, being located at the equator, receive considerable amount of sunlight, and with good irradiation, and that help us to actually provide opportunities for solar power plant, especially when we do have also sufficient land bank to actually provide for this, because land banks for solar power plant is actually quite huge. You need about, let's say, about 200 acres to cover for about 50 megawatts kind of power plant. Next page. So this is actually our success story. We actually helped this company called Edra Solar. This is actually a subsidiary of China General Nuclear Power Corporation, which is obviously a very large, Chinese state-owned enterprise, which actually focuses on renewable energy all over the world. And EDRA is actually the first company or the first investment that I've actually made in Malaysia. And we were very glad to be, given the opportunity to actually help them to arrange this bond transaction involving their first solar plant in Malaysia. And as you may appreciate, I think CGN has also issued many green bonds as well as green loans in the past, for which OCBC is also one of the arrangers as well. So this solar bond is actually the first ASEAN Sustainability SRI Sukuk in Malaysia, which has actually won an award from a few international publications. Next page. So the reason why EDRA Solar is unique in terms of the bond structure is because it is able to combine the green and the social criteria in order to be labeled as such. And as part of, besides just developing the power plant, as part of CGN's CSR program, they have actually allocated a major portion of their land bank to the local community, which are all local farmers, to actually develop agricultural opportunities by planting firstly pineapple, and after that other crops as well. So this initiative is actually done on the basis that it is without benefit to CGN. So essentially the land is actually given for free, and it will be managed by the government agency jointly with the local farmers to develop all these kind of crops. And all the benefits will then be accruing to the local farmers to support them. So this is, in our view, a very good initiative by a first-time investor into Malaysia to support, the local farmers in their, livelihood. Yeah. So next page. So next, I will talk about, sustainability-linked financing, which I will then talk about a case study as well. If you talk about sustainability-linked financing, as you can see, the bank and the clients are to set its own sustainability benchmark. And so this is actually different from the usual, sustainability bonds. And when you achieve a certain, what we call SPT, Sustainability Performance Index, then you will actually be rewarded with reduced pricing or even reduction in principal. So unlike green bond, all these price saving are market driven and will definitely not change over time. So the case study I want to talk about is the next page, please. So this bond issuance is actually sponsored, initiated by Khazanah National Berhad. Khazanah is actually a Malaysian sovereign wealth fund. And so as part of their CSR, they have entered into a public-private partnership with the government to actually set up trust schools. And this trust school is with the objective of actually, setting up many schools, in the whole part of Malaysia, and they will be providing funding for them. So in this quest to actually raise funding, they have also asked the support from the investor base as well to support this initiative. And this is where the Sukuk program came about. So this is the first social impact bond in Malaysia. Basically, the structure is on the basis of pay for success basis. So essentially, the investors will only be paid if they are successful in meeting the KPIs that has actually been set from the beginning. And the KPIs actually involves looking at, the teachers, the students, the senior leaders in terms of how they performed in the schools. And if they do meet the criteria that is set, then the investors will be paid. But at the same time, the investors are also given the option to waive all the rights and benefits to interest and principal, which means to say that you can actually take it as a full, CSR investments, and you're not going to be getting any returns out of it. So OCBC, as part of our CSR initiative, has actually subscribed to these bonds, which they have raised, 2 years in 2015 and also in 2017. Next page, please. So I think, in a way, I think, as a financial institution, supporting issuers or actually promoting for issuers to come up, to the market to look at, sustainability bonds and all that. I think it is important that we also will assist them in, in looking at what are the best ways to actually do disclosures as well. As you may appreciate, I think listed companies typically will not have a problem. They will, in some cases, they would even have their own sustainability framework as well. But not all companies would have that, right? So for private companies, that's where the issue is. So that's where we actually help them to look at, what kind of framework that they should actually come up with, with the support from, some experts, on all the sustainability issues as well. And with that kind of sustainability framework, then we can actually help to look at what kind of financing requirements will be able to be benchmarked against this sustainability framework. And with that also, we want to also continue to incentivize them, right? Incentivize them by giving them maybe discount in terms of the interest if they do meet all these, sustainability criteria that they have set upon themselves. So the sustainability disclosure requirements for bonds and sukuks and all that will happen, prior to the launch and at the deal launch and even after the deal launch as well. Yes, I think that's all for my presentation.
Thank you very much, Ai-Chin. I think you mentioned a very important and interesting point in the last of your slide is incentivize and also the discounts or loans in terms of interest or the loans in sustainability. That's very interesting. I think some audience might have some questions following this. Before that, let me just introduce our second guest speaker, who is Geng Yicheng from Ping An Bank. Geng actually is in charge of the ESG-driven sustainability development strategy and transformation of Ping An Group. She is a principal ESG expert in Ping An Group, and Ping An has actually become the benchmark for Chinese companies' ESG and disclosure. Ping An Bank is also one of the members for China UK pilot on disclosure, and I believe Crystal will also share us something about disclosure of the financial institution and also as a green bond issuer. So Crystal, the floor is yours. Crystal, can you hear us? Crystal, okay, seems to be having some kind of technical problem. If let's just move on to our first discussant, Sean Kinney, who is the CEO of the Climate Bonds Initiative, and also he is serving on the technical expert group on the EU taxonomy. Maybe I'll invite Sean Kinney to give a few comments on the discussion before we have Crystal coming back. Sean Kinney, can you hear me?
Sure, I can hear you fine. I hope you can hear me.
Yeah, I can hear you.
Look, it's a privilege to be part of such a fantastic group of people all working to create a better world in green finance. So thank you everyone for comments today, conversations today, and of course being part of this group. This is going to be a challenge for us in the coming year. We know we're dealing with a crisis. It's a crisis, we can argue, of resilience. Our systems are going to need to be able to deal with these sort of crises going forward. It's going to be a common feature of climate change, substantial shocks on a regular basis of one from another. So we've got to learn from it, and we also need to make sure that the future, the stimulus out of this is green, come what may. This is our opportunity now to rethink how the world works going forward. The whole issue about disclosure and reporting and transparency is part of a governance framework that ensures we stay on the right track for building a future for our children, and that's why this is so important. I want to make a couple of quick remarks about what's happening globally, to pick up a couple of comments and finish up with, well, I want to start off with some news. Today, Iberdrola closed the bond, a benchmark size bond in Europe, that was 11.5 times oversubscribed. I think that's the highest level of oversubscription I've ever seen for a green bond. We may be in the middle of a very, very tough market, but I'll tell you what, green is cracking. So bear that in mind. And others might comment on that. That's just a marker for the day. We've got a few highlights I wanted to draw. We did a report last year on disclosures, and we'll be doing a newer one later this year, we hope, subject to support from some of our partners like Ping An and Amundi, which found a few things. It found that China has the highest amount of use of proceeds disclosure. That's quite interesting. In other words, more dollars issued in China have good use of proceeds than anywhere else. Now, that's thanks to the regulatory regime that's been in place in China, clearly driving this. We've seen that the highest proportion of companies or issuers in the green bond markets that have got good disclosure are non-financial corporates. Now, of course, we have the odd fantastic bank like in Malaysia who's doing good work, but overall, good practice amongst corporates is leading the way. We've seen that in terms of sectors, transport and forestry, but transport being the big one, has about a 95% record of good use of proceeds disclosure, which is fantastic. The other sectors lagging a bit behind. We have, however, seen that there's about 200 different sorts of metrics used to provide impact reporting or reporting on disclosure, which is challenging for an investor because of the wide variety. If I can take you to the next slide, please. We've also seen a fair amount of regional variation, but the good news is that the largest markets tend to have high levels of reporting. That is, as a market grows and it becomes a feature of the country, the level of percentage of reporting actually rises and best practice becomes the norm. We've clearly seen this in China and, of course, across European countries, France, Germany, and the highest results are actually in Sweden and Spain. Japan, a latecomer to this market, is doing quite well on this as well. So we think this is going to improve. We've seen a significant improvement in reporting over the years. We have a change that's been happening over the last couple of years. We've gone from an ad hoc approach to the use of reporting around the world, lots of different metrics, lots of different approaches and so on, to much more formality and consistency. China, again, was the first jurisdiction to move on this, thanks to its regulatory measures. Of course, there are still challenges in China harmonising between the different regulatory settings. There's work to be done. But we've also seen the Green Bond Principles drive this, the Climate Bond Standard that you're aware of, and more recently, the proposal in the European Commission for a Green Bond Standard that drives this. So now we have a pretty common approach emerging around pre- and post-issuance reporting, which was not a feature of the early part of this market, and impact reporting, guidelines around reporting. The Nordics first bringing together some guidance this year, and now the Green Bond Principles and others working on this. So these are important developments. Now, what we're looking at really is also an approach to harmonise globally. We have an in-principle agreement between the European Union and China to work on harmonisation of taxonomy and also to look at harmonisation of green bond standards. I mean, that will take a while to do, but it's a fantastic step that we have that appetite. In fact, there's a new intergovernmental grouping called the International Panel on Sustainable Finance, which the European Union convened, and China is a key member of, along with India and a number of other countries, and we're hoping, by the way, Malaysia will join soon, that is looking at how to work on intergovernmental level on harmonisation and complementary approaches in different countries. So there's a framework, if you like, to take this forward going forward. That will become very important for rules and common approaches to use of reporting around this. To grow this market to the scale it needs to be, which is a market of many trillions of US dollars going forward, so it meets the need for the kind of investments we really need to shift our economies to become sustainable and green. We need to commoditize and make consistent our metrics, our reporting frameworks and so on, to make it easier for people to jump in, avoid confusion. So this is a critical part of the task going forward. Next slide, please. In Europe, there are a number of key developments. Of course, the implementation of the Task Force Climate Finance Disclosure recommendations is an important part of the European regulatory environment. It will now become mandatory for investors, corporations and banks, as well as green bond issuers, to disclose their sustainable investments, in the case of investors and corporations, banks, as well as their climate at-risk investments. And they'll need to use the common framework of the EU taxonomy to do that. In other words, we're embedding, as of the end of this year, an approach to ensure there's a common standard across all of these sectors for what we call green and what we call sustainable. That's a very important part of making it easier for this market to grow and common guide rails for everyone. That will have a slow phase in. We're leaving time for data provision to become available, which will require a couple of reporting cycles, we think, before that becomes a mandatory regulation for the segment. And Frederick Samama, of course, is in the middle of figuring out how this works. That has been a great supporter of this project at Amundi. The Green Bond Standard, which is Europe's approach to do what, attempt to do what China's already done with regulatory guidance, is coming into play later this year, and will do things like make mandatory independent review and reporting requirements. In other words, we should be able to reduce the ad hocery that we've seen and ensure that everyone follows a common set of principles and rules going forward in the European market. And that will, of course, have a flow-on effect to people raising funds in the European market, or because the taxonomy aspect covers all investor reporting in Europe, it'll also have a flow-on effect in that area to equities and other kinds of investment. So this is a step up in terms of conceptual frameworks for how we achieve common standards. It's quite clear that the transparency and reporting aspects are absolutely vital, as some of our other speakers have said, to ensuring confidence in the market and also to pushing change internally. There's many collateral benefits of doing this sort of approach. This process we're in right in the middle of now is how to turn this into standardized approaches. We, of course, also have the international standards organizations. I think we've got 3 separate working groups on different aspects of green finance, one on green bonds, who are attempting to codify these, and we have many participants from around the world in those groups, to pick up these themes, not to create new ideas, but to codify the work that's already been done in different jurisdictions so we can make this a global norm. And that should have a flow-on effect to issuers, to investors, and make it work. I know Ping An has been very committed to this process and has been doing its own bit to create green bond funds that are consistent with global norms. And I know that Aichin has worked on how to marry the global approaches with the Malaysian approaches. And it's very important to note that Bank Negara and the Malaysian Securities Commissions have been regional leaders in green finance and in sustainability proposals, and including incentives, by the way. So we've got some really interesting energy around the world. It's going to be an exciting year because I think not only will we further advance the standardization process quite quickly now, given we've got so many people looking at this, and there's many other countries that are looking at these issues as well, but also we're going to have an incredible stimulus to try and recover our economies. And the conversation, certainly in Europe, and I know in China, is about how to ensure that stimulus is green. And that'll be about green finance as well to make that work. So we'll see a lot more application of energy by our authorities, our governments and our regulatory authorities, and all of those of us who know this has got to be an important part of the future, to advancing it rapidly, really rapidly. So that Iberdrola story of 11.5 times oversubscribed, I'm sure will just be a harbinger of things to come. I'm looking forward to a green being the fastest recovery slice. I'll stop there.
Thank you. Thank you. Thank you very much, Sean, for your interesting comments and also points. I think you made a very good information to us that actually the latest issues of green bonds has been oversubscribed by 11 times, which actually will mean that during this difficult times like this time, actually people will realize that sustainable development is so important. This is a battle we cannot lose, and you have to invest the money in the right place. With that, let me just come back to Crystal from PI Group. So Crystal, can you hear me now?
Yes, I can hear you, but can you hear me
Okay,
right
the floor is
now?
yours. Yes, I can hear you. Please, the floor is yours. Please keep your time in like 50 minutes.
Okay, okay. Sorry for the trouble just now. So everyone can hear me, right? Then I can start. Okay.
Yes, please go ahead.
Hello everyone. Sorry for trouble just now. This is Crystal Geng from Ping An. I think Ping An is the only representative of the corporate whose headquarters is in emerging market. So it's a great honor to meet all of you online, and thanks for the host and co-host organized this webinar. Compared to HSBC, FC, or other peers who are the leading players, I think, in this industry with a long history, Ping An is actually started on our ESG-driven sustainable transformation since 2018. That is less than 2 years ago. But we have achieved a not bad result. So as an active player in emerging market, I hope today my share could inspire most of the corporates, especially in emerging market, who are still hesitating or confusing on whether they should do ESG or not, or if they have the willingness and how to do it. So I hope I can give some highlights on those questions. On this page, you can see is our business in Ping An. As you know, we are a comprehensive financial group covering insurance, banking, and also asset management. So on one hand, we are an insurance company. So we insure risks. So ESG risk is heavily associated with our core business, which means the ESG risk integration is a surviving topic for us. On the other hand, we are an institutional investor. By end of last year, our total investment is around 3,000 billion RMB. So to invest this in a sustainable way is very crucial to Ping An. So we believe we could act as an active influencer on the environment and also the society through our insurance and also investment business. Next, please. Next slide, please. Next. Okay, first of all, I would like to share our sustainability core issues, which I believe is the fundamental points for any kind of disclosure and also the information management. You should know very clear who are you and where you could work on regarding sustainability. Then you can do the disclosure and management and so on. You could see in Ping An, our issues are in 3 aspects. The first one is about the corporate governance. The second aspect is regarding to our sustainable business integration. And then the third part is about our responsibility to the community and the environment. We have established 500 ESG indicators under those core issues. And also we established a very sound and comprehensive management system. I mean, all the policies and the management procedure, you can find it on our website. Besides, we have created an AI ESG platform. Since last year, this platform can give us a very useful tool to manage our ESG informations across our more than 40 subsidiaries. So that is all the efforts we have done on ESG disclosure and also management. Next slide, please. This slide is actually our double positions on ESG. First one is we are the listed company. Now we are A and H listed. So we are facing some encouragement and also pressure actually from the capital market, especially from the institutional investor from developed market. So this is a motivation for us as well. And I suggest other corporates, I mean, especially in emerging markets, could start with this to push the ESG work within your organization. I have listed the ratings and indexes here to show our improvement, and the reason is those assessment framework is a great reference for us to build our pool of ESG indicators for disclosure. So it's a very good reference and starting point if you want to do a good job on ESG disclosure. Secondly, as for an investor, we joined a few influential organizations. As you can see here, we are the first Chinese asset owner who signed PR, and also we just signed GIP as well, and also CBI as well. They all provide us with very good practice and good advice, and also it provides us very important occasions for exchange opinions like this webinar we have now. Next slide, please. This is some latest result of our ESG performance in last year. I list out some figures. These figures are under 5 rules of Ping An. So I am not going to talk more on the actual figures. You can find it in our website, I mean in our sustainability report. Next slide, please. Sorry, I think you skip one. No. The slide before. Sorry. Yes, this one. This one is the one Sean just mentioned. Last November, our asset management arm in Hong Kong issued a China Green Bond Fund. The fund is based on CBI green standards to build and manage our portfolio, and the fund is targeting professional investors. So the green bond insurance in China and the emerging markets actually accounts for 26% of the global green insurance in 2018, and has maintained a good growth rate over the past 3 years as well. So I show you some actual figures for this model portfolio. You can see our average credit rating is as high as A minus. For the countries, we are focusing in China emerging market green bonds offering, and if we look at by the sector, it is all well recognized by CBI green standards to ensure the ongoing green requirements could be compliant. Okay, next slide, please. Then I'm going to talk about the other thing, which is the TCFD report we released last year. It is our first try to give this kind of TCFD disclosure. And as far as I know, this report is the first TCFD report in China. We strictly follow the suggestion given by TCFD, which is the governance, strategy, risk management, and also metrics and targets. From my point of view, I think the government is very crucial because you have to establish a very effective and systematic management system, and then you can do all the other things. I mean, to make a strategy, your policies, and to how to incorporate the risk management in your business. I think I'm going to give you a very quick go through of our report in the next few slides. Please go next. Yes, this is the governance part just now I mentioned. So you can see we have 4 levels of our climate change governance structure. The most top one is, of course, the board of directors. And then you can see we have incorporated the risk management executive committee, investor relations and the ESG committee, and also the investment management committee inside to review and approve all our related targets and strategies. And then followed by level 3, who is our group ESG office, and also level 4, which are our subsidiaries. Then next slide, please. This is our responsible investment policy. I'm not going to give more details on this slide. Actually, I'm not going to give some details on this sharing session. And if you are interested, you can read the following, I think, 4 to 5 slides, which is talking about TCFD reporting. And also you can download this report if you are interested in our website as well. I think that is all of my sharing because the time is very limited, so I want to give the time for Q&A maybe. Thank you.
Much, Crystal, for your interesting introduction and also some highlights on the Ping An Group's performance and also on disclosure, especially by following the TCFD's recommendations. So now let me just invite Francisco Avendano from the IFC, who is the Climate Operations Officer in Climate Business Department. He's leading the implementation of green finance instruments and also global focal point for the climate metrics at IFC, covering green bonds, green loans, climate loans, guarantees, etc. And Francisco, the floor is yours.
Can you hear me well?
Yes, I can.
Great. Well, thank you for the opportunity to be a final discussion on this webinar. A lot has been said today regarding disclosure. And disclosure is happening. We see that emerging markets, green bonds are growing. And as that growth happens, we're also having a lot of disclosure. And CBI already mentioned that the most of the disclosure is happening in those more mature markets. But the question is that how is this disclosure taking place? Is this being comparable? Is this being ready for use by different groups of market participants? Not necessarily. If we look at what is happening in different stock exchanges, for example, in the Luxembourg Stock Exchange that holds close to 50% of the global green bonds, so they have, as many other capital market infrastructure agents, they have the duty of organizing information that they receive and make it available to the market. But if the information is not necessarily under the same units or is comparable or is ready for analytics, then it is very difficult for market transparency to go to the next step. You know, one thing is to provide the disclosure, and another thing is to have the disclosure really ready for being applied for decision making. In the case of the Amundi fund, for example, the Amundi asset management fund that we have together between IFC, Amundi, and others, that fund is exposed to multiple geographies and multiple markets, but each geography may have their own approach to, let's say, how to do the reporting, how to do the disclosure. Even in some cases, we have specific taxonomies for particular markets. So how do we make sense out of that data? And right now, if we look at the market ecosystem, we have investors, external reviewers, ESG data providers, and market infrastructure entities such as stock exchanges. And we have also the need to increase transparency and credibility to the market. So how do we do that? External reviewers have a particular contribution to make, and they provide the assurance that is needed to make sure that we are not greenwashing. But that activity needs to be at least comparable. No, I have seen external review reports that are one page with a couple of sentences saying, yes, this is green. And I have seen others that are very long, but not necessarily providing a lot of actionable information for investors. So I think there is still a gap in the market to be able to aggregate information, to make information comparable. And this is right now very critical in light of some developments, such as the EU taxonomy. As you may know, much of the international green bond investors come from Europe. So in a way, they will have to observe the EU taxonomy in the process, on how they invest potentially in emerging markets. Not necessarily they have to follow that to a letter, that's still to be analyzed, but it will have an impact anyway. So in order to make the domestic approaches in different countries and different markets not necessarily the same, but at least consistent with the EU taxonomy and with other important standards, there is a need in the market for a protocol to translate apples to oranges, oranges to strawberries, and all that to make sure that we are aggregating and using the same type of information. IFC is working on that. IFC is working on the development of a green finance review protocol. So we are looking at not only an asset level type of taxonomy, but also trying to link what is the impact of those, let's say, green bond private sector activity on the ground to the overarching countries' targets. No? Because if a country such as Colombia or even, let's say, Malaysia sees that there is a lot of activity on their green bond issuers, they have the question, so what does it mean for our climate targets? What does it mean for our targets, for our NDC? So that's not an easy answer. Why? Because the labels are not necessarily the same. Countries at the national level, they use so-called MRV systems to track national expenditures and investments on climate-related actions. And on the other hand, you have, at the ground level, you have banks and corporates that use asset level taxonomies and labels. So I think there has to be a protocol in between to be able to compare apples to apples and also to link different markets. This is what in IFC we call the Green Finance Review Protocol that is being developed and very soon will be socialized through different initiatives, including the Sustainability Banking Network. And this comes as a response as well to providing extra granularity and more specifics to what is green on the market. No? If we look at the green bond principles and if we look at the available taxonomies, they cover a lot of climate-related action. They also cover a little bit of the extra green, not necessarily climate, but they are not very granular in some areas that are considered urgent at the moment. For example, blue bonds. You know, there has been a precedent on blue bonds from the Seychelles Islands. Basically, blue bonds are a type of green bond that is very specific for ocean protection and water resources. So, but if we look at the green bond principles and the list of indicative activities, or if we look at available taxonomies, not necessarily they provide a lot of granularity on what could be considered an eligible use of proceeds for a blue bond. No, if we look at what we have right now on the public domain, we have some general top-down reports like the Ellen MacArthur Foundation report on the blue economy and what needs to get done to scale up the blue economy, but we don't have specifics. So we have questions from our clients in terms of what could be an eligible use of proceeds for a blue bond. No? Then we can do our research. We have, as IFC, provided an orientation note to our clients, to some financial institution clients, to say, okay, for example, there is already an ongoing certification system for the fishing industry, and they have standards, they have a benchmarking mechanism, like the Marine Stewardship Council certification for the fishing industry. So if you have investments that have this certification, or you have some fishing products that are with a very high score or blue label on this certification, then that could be a potential use of proceeds for a blue bond. That's the type of specifics and granularity that the market is demanding. Specifically in East Asia Pacific, we are seeing demand on this. There is a need to not only to say where are we spending the resources or the proceeds from the bonds, but also there is a demand for specifying what is the impact of those use of proceeds. ICMA has provided a very detailed list of impact indicators that are presented for impact reports. We see that there is a lot of disclosure on impact, but not necessarily on impact indicators. No, many times we see annual impact reports that are detailing the pie chart regarding different use of proceeds by project categories, but not necessarily specifying the impact per category. And this is very important in order to have a proper documentation of the actual use of proceeds. This is my 2 cents for this webinar. I'm happy to answer questions.
Thank you very much, Francisco. I think your points are very good. And conscious of time, I think I probably will need to summarize a little bit and then give you one question for each of you and 1 minute to answer. So I think it is not even a question for the green bond issuers or financial institutions to disclose or not, but it's more like what to disclose and how to disclose. And our guest speakers give us some answers. For example, OCBC said actually they would provide some incentives for the green bond issuers that they are arranging. And for the Ping An group, actually they are themselves are doing the pilot project, including the China-UK pilot project, and also they are member of the GIP, Green Investment Principles, by which they're also encouraged to do a lot of disclosure, for example, by following recommendations of the TCFD. And for the Sean Kinney, the CBI and the green bond issuers, I think it is even more closer and clearer that actually green bond issuers need to disclose to their investors as to what information they could have, and also how much environmental benefits these green bonds are creating. And since Francisco, you're also already talking about the green and the blue bonds, maybe the first question will come to you. So I'm picking up one question from the Slido, and people are interested in this topic. So blue bonds are actually a relatively new type of sustainability bonds that finances projects related to ocean conservation. Can you tell me what is the difference between green bonds and blue bonds, and what will the World Bank do in the future? You have 1 minute to answer, maybe very short, but please, the floor is yours.
Thank you for the question. Well, actually, a blue bond is a very specific type of green bond. The Green Bond Principles is basically a transparency framework to organize and communicate information on the bond. No? So when we talk about blue bonds, we need to be more specific because so far, as I said, we need to be precise about the use of proceeds that have a concrete impact on ocean protection. That is not very explicit. If we look at what we have on the indicative list in the Green Bond Principles, that is not necessarily present in the available taxonomies. So that's why in light of this market gap, IFC initially for its clients is coming up with some orientation documents to guide the process of structuring blue bonds, taking into account very concrete use of proceeds and that help on ocean protection, and organize this information taking into account the Green Bond Principles. We don't need to necessarily reinvent the wheel or to say we have to have blue bond principles separate for the green bond principles, but we need to be specific on use of proceeds for blue bonds. So we have to follow the same logic behind the green bond principles, but to be more specific in terms of granular use of proceeds that help on ocean protection. That's the main difference.
Thank you very much, Francisco. Now, my second question goes to Ai-Chin from the OCBC Bank. So what are the key challenges for green bond issuers in meeting and disclosing environmental requirements to be listed as green? Ai-Chin, are you still there?
I think for the listed companies, it will not be a problem because typically they will be required to do all this disclosure by their own stock exchanges and all that, and they may already have their sustainability framework. But I think the issue is really for those private or smaller companies where they may be reluctant to actually do this disclosure. Mainly also, maybe one point is because they don't want to lose their comparative edge, or maybe the other point is also they don't actually have the adequate, governance structure. So I think in this respect, maybe the solution, for us to help them is to facilitate, the appointment of external advisors who can actually help them to establish all this kind of sustainability framework and to assist them in terms of the reporting requirement. But of course, the challenges to that would be then, there will be an increased cost to these kind of, issuers and all that. And that's where I think we talk about maybe one point to consider for the banks, is actually to look at giving them some incentive back, if they're able to actually demonstrate that they are able to actually meet all these sustainability criteria. At the same time, I think to also look at whether are they able to, successfully do some impact reporting as well. I think one of the questions in Slido talk about, how do they disclose impact reporting instead of allocation of use of proceeds. So maybe that's the part that we can actually incentivize them on as well.
Thank you very much. I think that's a very clear. Okay, my next question goes to Crystal. I know actually you're already disclosing your company's financial and environmental performance by following TCFD recommendations, but actually what kind of recommendation would you have for disclosure metrics to be used by companies, for example, your clients or any other financial institutions as well?
Okay. Regarding what kind of disclosure metrics we should use, actually in Ping An, just now I mentioned we develop an AI ESG platform which can manage our ESG information across our 40 subsidiaries. This platform consists of, this system consists of 4 categories. The category which is environment, social, governance, and business, it covering around 500 indices. This system actually we develop with a combination of a lot of reference and guidelines, such as the Hong Kong Stock Exchange and also Shanghai Stock Exchange. We also take reference from MSCI, DJSI, and also we add some Chinese style indicators on this system. So you can develop your own disclosure metrics based on a lot of the reference which is available on the market, because on one hand you have to be compliant with the listed stocks, as a listed company, and also you want to have the higher capital market valuation. So that is why you have to take consideration of the rating agencies such as MSCI. So that is my suggestion.
Great, thank you very much, Crystal. Now my last question will go to Shankini. I'm choosing the question from the Slido, the number 3. Since each country has its own regulation, if there is a better one between mandatory and voluntary environmental disclosure. So let me just blend it. Someone also think it's a challenge, like independent review and also reporting requirements. So what is your suggestion to overcome such a consideration and also a barrier?
We've got global capital markets, we know that. Yes, it would be easier if we had a common global framework. But hey, we are where we are. In the meantime, you look at where you're raising funding and you have to meet the regulation or the best practices to that particular market. I think we're used to doing that. If you want to raise money in China, you will need to meet one of the Chinese set of regulations, depending on which market you're issuing into. Ditto in Europe, ditto in Colombia, because there's a taxonomy being worked on in Colombia. In fact, we're collaborating with our friends at IFC and Francisco on supporting the government there and so on. So, I think the simple answer is you have to work in what's the best practice in that particular market. But it's important to note that the framework for regulation and guidance and rules everywhere is actually the same. So if you look at the green bond principles, you will understand the basic principles in pretty well every market. There will be nuances, especially where there's a strong regulation, as in China and soon to be in Europe. You'd have to look at the specific regulation. There is work to harmonize. That will become easier over time. But, if you're going to raise money, if you're an Indian issue and you want to raise money in the Singapore, Hong Kong and Paris market, you will be having a look at those regulations and doing disclosure in line with the guidelines and regulations of this market, knowing they're not particularly different. It's not necessarily going to be hard, but you'll have to have the boxes ticked. And that's why you have an independent verifier. That's their expertise. They can make it easy for you. This is not a big barrier. That's the main thing I would suggest to you. And of course, where there aren't guidelines available locally, and many regulators do, and in fact, Cheng Lin and Ma Jun have been party to many discussions over the years of regulators helping to develop their own guidelines. Then you can use the international default mechanisms, which is green bond principles or climate bond standard, social bond principles, and so on. And they work pretty well everywhere. So I don't think it's that hard an issue, but I do appreciate that people are looking for more guidance on things like impact reporting. That's why Chin's comments were so useful. And I think you're going to see more of that coming out. It's certainly a feature of what's happening in Europe in the green bond principles. So this will develop. We've got to be careful not to make it harder. We've got to commoditize, standardize, and simplify while ensuring the appropriate levels of transparency and reporting are there to ensure confidence. It's that tension we're working on. It's something that you will see more developments on in the coming year. I hope that answers your question.
Yes, that's a very good question. A very good answer to my question and also the question from the audience. So once again, thank you very much to all my guest speakers and discussants. And now I actually conclude my second session, which is also second part of our WebEx webinar. So now I'd like to hand over back to Rosani for maybe further announcements and wrapping up. Rosani, the floor is yours.
Okay, thank you very much. I'd like to say thank you to all our distinguished speakers and moderators. We are reaching the end of our webinar today, and we do have a little bit of a housekeeping to let you know about. We will be uploading the recorded video for today's event on the GFLP website. Please do visit for the latest updates, and answers to some frequently asked questions will also be found in the same place. If you have any additional questions regarding the subjects discussed today, you can email us the questions. And all the questions that you've asked today that we were not able to answer, we will collate all the questions between now and the 30th of April, and we will strive to answer as many questions as we can, and all responses will be posted on the GFLP website. We do have an evaluation on Slido. It's now open. Please do spend a few minutes completing the form, and it will help us in planning of future events by catering to your needs more specifically. Shenlin, do you have any more further comments before?
Yes, yes. Well, actually, our audience are finishing the online poll from the Slido. Let me just welcome Dr. Ma Jun to give us a welcome and also wrap up speech. Dr. Ma, the floor is yours.
Thank you, Shenlin and Rosani. I'd like to say a few words on three topics. One is what are the drivers for disclosure? That's actually a question I think raised by many people in the audience, but we haven't had a chance to really discuss in depth. I would say number one driver is regulator. This is something that Sean Kinney has briefly mentioned. Just give you experience of China, our banking regulator back 7 years ago began to ask the banks to report their green loan balance. That was the initial effort, but later on it became more extensive requirements. And 4 years ago, when we put out the green bond regulations, we asked the green bond issuers to disclose the use of proceeds and environmental benefits. So these are all requirements from regulator, which definitely had a huge impact on the issuers and on the banks. And more recently, the discussion is now going on between different regulators in China, including Environmental Ministry and other financial regulators. They are planning to publish a requirement for mandatory disclosure of environmental information by all listed companies and all bond issuers. And I'm expecting that new regulation to come out this year. If this is materializing, I think it's going to be significant impact on all major players in the market. And globally, there are many efforts in the same direction. For example, EU is now considering some mandatory requirement for disclosure. And I think UK and France have put out some requirements already in years for financial institutions to report climate-related information according to TCFD. The second driver, I think, is investors and financial institutions themselves. Many investors, they want information, as I said earlier, to distinguish green versus brown assets so that they can allocate the assets or capitals to the right place. And also some of the FIs, they want information to manage their risks, especially risk arising from environmental information exposures. And the third driver is a combination of many players, for example, verifiers, NGOs, research institutions, MDBs, and so on and so forth. They provide capacity to many of the issuers and the borrowers to help enhancing their ability or capacity to disclose information, calculate the number they want. And the fourth player or fourth driver is what I call industrial associations. Just to give you an example, the China Green Finance Committee as an industrial association in the space of green finance, together with the City of London, 2 years ago, launched the pilot program between China and UK on environmental information disclosure. And now we have 13 major Chinese and UK financial firms joined this program, and they volunteer in disclosing more information than the other players in the market, leading the way of essentially creating standards and templates for better disclosure. Ping An is one of the members of the task force. The second question I'd like to touch upon is, again, what Sean Kinney said, harmonization of different standards in different jurisdictions. The largest two green finance markets, China and Europe, are now in talk. Very likely under the IPFS, which is the International Platform for IPSF, Sustainable Finance, there will be a working group between China and Europe working towards harmonizing the Chinese green finance standards and the European sustainable finance taxonomy. My own vision is that this working group will work out what I call the common ground for the two sets of standards. And that common ground essentially is an overlapping portion of what China considers green and what Europe considers green. And this will be the higher standard than the Chinese and then the European standards. And that common ground can be used by, for example, Chinese issuers to issue green bonds in Europe and European issuers to issue green bonds in China, therefore facilitating low-cost transactions for cross-border green capital flows. But there are many other benefits of this harmonization exercise, including setting the benchmark for some international dialogue on consistent or harmonized standards for the global green finance market. The third topic I'd like to touch upon is a little bit digression from the topic of disclosure, but definitely I think in the heart of green finance during this particular moment, which is the pandemic of COVID-19. The issue is many countries are now putting out stimulus programs. And I think many of these countries want to invest significantly in infrastructure, in some of social projects like schools and hospitals, and many other areas. Now, the issue is how do we make sure this new round of stimulus program, which is probably larger than any others in history, is green? And we are hoping that more people, including all the participants for this webinar, can participate in this discussion. My personal view is that we want to do three things to make sure the new stimulus program in many countries are green or greener, at least, than before. Number one, we include more green projects into the stimulus program. Funding is directed to greener allocation. And secondly, we want to make sure all projects, whether they are classified as green or sustainable or not, they need to meet environmental and social standards. Therefore, every single project in the stimulus program do not harm the environment and do not generate too much carbon emissions. The third point is that incentives the government is now thinking about giving to various kind of sectors need to be focused or more targeted to support green, rather than giving out to corporates and sectors and segments of population with no respect for greenness or sustainability. So I'm really hoping that the audience today, which Cheng Ling told me has reached 1,500 people, much more than I thought earlier, the 600 number, can participate in this dialogue and voice your support for the green stimulus to your regulators and your policymakers in your country. So with that, let me conclude by saying thank you all very much for attending this webinar, which is one of the events under the Green Finance Leadership Program, co-hosted by Tsinghua University, by IFC and World Bank in Malaysia. This is one of the new forms of our communication and dissemination of green finance knowledge. But I think in the many months to come, we probably have to stick to this form of webinar in order to reach out to a larger audience with low cost and with minimized carbon emission. So really thank all, including the organizers, the audience, the speakers, and also the supporters for the Green Finance Leadership Program, including UK-based Hewlett Foundation and Grover Foundation. And I'm looking forward to further dialogue and discussion with all of you in the near future. Thank you.
Thank you very much, Dr. Ma. I think our colleague told me like a moment ago, the latest number of observers is more than 3,000, more than 2,000. It's 2,350. So plus YouTube, I think it's more than, it's close to 2,500, which is a great plus and a very important encouragement for us. So maybe just a little bit of advertisement. This is the first series of the GFRP webinar, but actually we will definitely carry on. And please keep an eye on our website. Next slide, please, so that actually our website will be displayed. It's gfrp.org.cn. Future events will be announced here. And if you have any other questions related to the topic in green finance or the topics we discussed today, please feel free to send email to us so that we will compile that into some of the frequently asked questions. And also including the video today will be maybe made into a short video and available on our website as well. With that, I would like to announce the closing of today's webinar, and thank you very much for watching. Goodbye.
Hey, thank you.
Okay, dear guest speakers and also participants online, I think our live broadcast is now over. Please feel free to close this, and we will actually keep in touch with you. Should there be any questions coming from the audience who do not have a chance to raise it or were not answered today, I think we will also send that to you if it is for you. Everyone, thank you very much and have a good day.
Thank you to you. Well done.
Thank you.
Thank you and goodbye.
Thank you. Bye.